Hey everybody, it's Pete Carmasino here at Chaikin Analytics. Welcome to this week's halftime show here on StockCharts TV. Each and every week, we kind of go over some things that are happening in the market, and we're going to look at some secret lists, I like to call them, here at Chaikin Analytics. They're not so secret if you're a subscriber to our platform, but I like to show them because once in a while you get a feel for how our signals are kind of reacting to current events in the market, what's going on. And speaking of the market, I mean, we're in a mixed bag here. We had the first quarter ending here. It was a pretty successful quarter for tech, and even the S&P did, a pretty well, had a good performance as well. I mean, this is expected. I mean, I don't want to call it mean reversion, or I don't want to label this at all. Basically, what we're seeing is sort of the inflation declining, interest rates potentially slowing at their pace of increase, but at the same time, we're not seeing inflation turn around, right? And when inflation slows, it's not deflation, it's disinflation. And so when it's disinflation, it just means it's going up less, right? So again, inflating a tire, you're just inflating it less. You're not letting the air out. That would be deflating it, right? So just remember that simple analogy you'll never forget. But at the same time, we're going to have to get used to prices to staying higher. And that's really the gist of the situation here, is that, there were expectations for the Fed to at certain levels of expectations they thought for inflation, I should say, and that inflation expectation has been raised. So the idea of the Fed as being late to the party is obviously out on the table. We know that. And the second side of this is there's an old saying out there that says, don't fight the Fed, but the markets seem to be fighting the Fed in the way that the bond market's behaving, where it's been lowering rates, but not today. Obviously rates are increased today because bonds are selling off. So you're just seeing this push and pull until we get some concrete evidence, either from the Fed or from the data or vice versa, depending on which one comes first. We're going to basically sit in this area of a trading range, which we've been in now for quite some time. If you look at the chart on a long-term basis, we're basically at, levels that we saw 2 years ago. So it's not the best message, but at the same time, we've seen sectors doing really well. Obviously, tech has done well. Communications, discretionary has been doing okay. They've turned the corner. But XLK, that sector ETF that we follow, and obviously the Qs, had a banner quarter. I mean, this is incredible because of the fact that when rates are implied to slow or potentially stopping from raising as high as they've been, that sort of takes the headwind away from those sectors that are most affected by interest rates. So you saw cyclical sell off a little bit. So, and tech rallying, and some people are saying it's tech is safe haven. I don't know, but we're going to look at the charts today. We're going to look at some names that we're seeing that are giving us relative strength sell signals on our platform. And we'll just look at how we're ranking the certain sectors here to get an idea of the current level of attitude, sort of sentiment from a sector position. All right, let's go to the charts and see what we see. All right, everybody, we're here on the Chaikin platform. And obviously, you can see that I've got something called the sector ETFs here, the SPDR, the SPDR sector ETFs. And we just rank them right now. You can see there's a little arrow here, down arrow. It says it's ranked in order of rating, okay? And so we obviously have a very bullish rating all the way down to bearish. There's no very bearish, which is interesting. But we kind of look at, we give you just a quick overview of performance the last 3 months or so. Look at XLK. Has done incredible, 19.5% versus the S&P of 5.4%. Again, that's 3 months, not exactly a quarter, but close enough. Quarter just ended on, last week on Thursday, and so, or a week ago or so, at the end of March, and so you're looking at that year-to-date level here of 7% on the S&P, which is pretty effective from an investment standpoint. Look at XLC at 22.8%. There's consumer discretionary at 12.2, all beating the market, right? So if I just rank these by year to date, the best two are communications, information, and followed closely by discretionary and then the S&P, right? If I go back to just ranking by rating, you can see where we stand, right? XLK, we've been talking about this. I mean, we do these videos for multiple reasons, right? To kind of show you how to navigate the ACP platform, but also how the Chaikin platform can help you kind of identify things. And look at where the XLC was when it broke that one on the ratio, again, relative to the SPY. It broke out around that January 19th. And I say broke out. What I mean is it just broke above that 55 EMA that I look at. that it crossed later. So this was sort of confirming maybe a little bit more conservative place to be. This would be an aggressive area. But even on the index itself, on the ETF, I should say, the sector itself, it crossed even earlier. So even beginning of February. So you've got 3 or 4 triggers here. The first one was the sector itself. The second one was the ratio. The third one was the sector 55 crossing above the 200. And the fourth one was the ratio 55 crossing above the 200, right? So look at it in order of stages, right? One's very aggressive, right? The first one, the second one is kind of validating it, and so on and so forth. And if you look at XLC, we might see the similar thing. I haven't even looked at this morning, and it's a very similar situation, right? The end of the year, we saw the ratio crack. Then the next one was the sector itself. Then the first one was the sector ETF crossing above the moving averages, and the third one was there. So all of these are kind of happening in order. This is just one way to look at this. I'm not saying this is a perfect setup, but my point to you is that process is just a process. It's one process out of a million processes out there, right? Can it help you? I hope so. Is it the best opportunity and best way to manage? I don't know. I haven't tested it, but my point to you is that a lot of other sectors are not showing that. Now, XLY has performed, but it's just not validating, right? So it would be an aggressive move to be in the discretionary sector here. Both the ratio and the ETF kind of cracked that 55 EMA at the same time, but the EMAs have failed to cross above or signal a higher level here. So a little bit of caution here. If you're using this as a way to enter into markets, you can say, maybe I do a small percentage down here. I add another percentage when the second trigger has. I add a third percentage, and maybe you round it up to somewhere where it equals to 100 or 10% or whatever you want to do. I'm just throwing some ideas out there. Let's look at defensives real quick. XLP, a similar situation. Now, this really never cracked on the downside from the sector standpoint, but look where these started to perform. This was back in October. What was happening in October? The market was bottoming. And so defensives were getting some traction. Did they sell off completely? No, not really. That's first signal still is intact. But look here, this was really the ratio was one of the first ones to kind of stay intact. When this rolled over, that would have been a signal that things are slowing down, but the ratio held tight, right? So these are just different ways to look at, different setups, right? I'm not saying it's the hard and fast rule that you have to do it that way. What I'm saying is it's just one way to look at it. We've been talking about oil in that White House buy zone. I talked about this several weeks ago, and then obviously OPEC came out and started to cut production, which then oil just rocketed higher. But the question was, we thought this would be a buy zone for the Strategic Petroleum Reserve. It didn't seem to be, and again, I don't have any evidence that they didn't make those purchases. But what I'm hearing and reading is that it's not being tracked and not being verified. So I assume it wasn't made. Point being is those were levels that we could have been looking at. Rally 6 is still intact. It hasn't started to roll over. But again, we're looking at where it started. When did it start? It started in March. And we looked at some of the big sectors. Let's go back to XLK real quick. And when was that starting? April, right? And then obviously the ratio started heavily in the beginning of March. So is it verifying that rally? It's just maybe coincidental, but at the same time, we're looking at rally 6 in the markets. Head and shoulders, people are starting to call this pattern out. I've been on this now for over a year or more, maybe 2 years now since I started drawing this. And I had drawn this one as the recent one and thought that this particular sort of double right shoulder was forming. It did form and then kind of moved around. So this is getting pushed and back. That's that range we're talking about. We're not getting some excellent traction here at all. Now, other folks, are looking at this mini head and shoulders that's forming right here. So you got the left shoulder here, which is my old right shoulder. The head is in the middle here. And then here is basically either another shoulder or another shoulder, second shoulder forming. So there's some of those patterns popping up on there. Again, it's kind of fun to look at these and see if they play out, but it gives you an idea of where we're heading and why. Jumping back to the sectors, as I said, we're looking at the top sectors here, and it's interesting to see that materials squeezes in the top. Again, this is by rating, not by performance year to date. The year to date is hard to compare to some of the tech trades that have happened earlier this year, but it is ranking very high. Now, it's not very bullish. There's only one sector that is. That's the information technology sector. And they're not far behind is the staples and industrials. But staples is something that we're talking about, didn't really crack yet on the downside. And a year-to-date performance of very, abysmal at just 1%. But hey, better than nothing. The other two aren't doing so well. There's healthcare that's down about almost 2%. And here would be utilities. If you look at utilities, I can just pull that up real quick and show you that, this utility sector has not been doing fantastic. But again, from a risk-off perspective, it really hasn't done much at all. Again, down about 1%. So let's pop over to my workspace here. We're going to look at some of those lists I talked about. All right, as I said, I wanted to go over the relative strength sell signals here. And, some of these are basically the way our sell signal is sort of calculated, and without giving away every piece of it. It's pretty simplistic. You can see what we're looking at here. We're up against that long-term trend line, but that's after we broke it. So a little mean regression or regression back to that trend line. And then we have to be overbought, which we are, and we want to see relative strength that has weakened in the previous month or so. And so when you look at those setups, even Chaikin money flows failing here a little bit. So you see this oil sector, oil equipment and services, not oil sector, oil equipment and services ETF. It's just giving us an overbought sell signal just because the relative strength is fading there. Now, you're seeing a lot of other names that you can start to see that might be in the same relatable industry. And here's Peabody Energy's a coal corporation. Again, another setup here that's kind of showing that same pattern, right? And if you look at all of these, look at this triple National Retail Properties, triple net lease kind of a acronym. Weak trend, weak industry, regression to the mean, negative relative strength, bad money flow, overbought, right? And so we're looking at these and saying, all right, these are continuing a downtrend, fighting back a little bit with the market helping as a tailwind. Maybe the implied pause in rate hikes could have been an effect here as well. The overall market was rallying in March. We just looked at that, so that was helping as well. But again, when you start to see these, you just got to be careful. Now let's look at some of the names that are actually bearish. And here's Chesapeake, already in a big downtrend, but tactically just getting overbought, and then relative strength is just being pinned down on the negative side. And just a couple names here: PDCO, Patterson Company, is a healthcare provider. Again, that already cracked, but it's range bound, not as dramatic as the other ones. Let's look at FAD, which is First Trust Multi-Cap Growth Alpha Dex Fund. Again, range bound, nothing that's exciting here. But if I look at, again, some other names on the other side of neutral, which are neutral plus, and even some bullish ones, you see an early relative strength here changing. A chemical corporation, FMC, again, regressed up to the mean. When did that start? Bottom, middle of March. We saw the market started to change in the beginning of March. And so, again, the tailwind was the market. But these are some names that I would just be paying attention to that are giving us some sell signals here. And I'll just look at one or two more. Alpha Metallurgical, I believe that's resources, that's going to be metals and mining. Again, sideways action here, nothing that's really confirming up or down. We've been battling back and forth on relative strength, but just, traditionally here looking at a weaker trend, but the industry's strong. So that's one you want to just pay attention to. And then Archer Daniels, again, that downtrend is intact. A little bit of a regression here. We're in those volatility bands, but that crack back here, which would be beginning of the year, right? And so kind of sell off. That's just a continuation. All right, everybody, that's all we have for today. I just wanted to kind of go over some things that we're seeing here from a sell side of things, being some things that are just rallying back to long-term trends, and with negative relative strength sort of confirming that downtrend that's already started at least several months ago, if not several weeks. So we'll be back here next week. I hope that helped you today. Again, Pete Carmasino here at Halftime Show on StockCharts TV. Take care.